When we heard the news that there was going to be a snap election, I think everyone in the office was really surprised. I think it caught the whole country by surprise. But when we stopped to think about the reasons for it, it made a lot of sense. The perception from the market is that this is a good move, will in the long run reduce uncertainty in the UK, although in the short run it caught everybody by surprise. So if you look at the way our own funds responded, I think the fact that our equity income funds hold what we hope are stocks that are for the long run. We have certain criteria we look for. Not too much leverage, they haven't over borrowed, good liquidity, good cash flow generation, reasonable dividend yield, prospects to grow that dividend yield. Then hopefully what we have with those stocks is that they won't wobble as much as the market overall. And that's not always the case, but a lot of the time it is the case, and that generally was okay when this occurred, when the markets wobbled. In fact, our UK equity income fund did extremely well. But we are long dollar. We've been using dollars as a means of hedging out some of the risks we saw arising in the UK. So when you get a reversal like that, that's when your hedge goes against you. So that caught us out for a couple of days. We need to rethink that. We're not going to panic. It's not had an horrendous effect on anything. And that's just the nature of the beast when you work in this market. Every day doesn't go the way you want it to go. It will certainly make us rethink. And one of the things we're doing at the moment is looking very carefully at where we think the sterling dollar, sterling euro relationship is going to go over the next year, 3 years. Politics is still the issue that we are most concerned with. And as I've said in articles and in these chats previously, politics is the most difficult thing to manage for, because one never knows what the outcome will be. Politics changes very quickly. As we found with Theresa May suddenly going for a snap election, we just didn't see that coming. There's not really been any discussion about that in the past 2 or 3 months. There's a lot of turmoil around, and that's always a major issue. And you have to look at that, and what we've been trying to do is look at this as to say there's potential for big shocks, and therefore you try and put some protection around the portfolios. When we're looking at returns in the investment team, they are synonymous with risk. You don't get a real return of 5 to 6% per annum from equities over the very long term without taking some risk. If you don't want risk, you sit in short-term treasuries, short-term UK government bonds, gilts, cash, and then you get very little risk as long as you haven't put too much with an organisation that goes bust. You don't get too much risk, but you don't get the returns either. So whenever we take risk, we are looking at what the payoff is for that risk. In other words, will we get well paid for taking that risk, for accepting those ups and downs? Will we be well paid? 2017 is very different to 2011. In 2011, markets were generally still scared witless over what had happened 3 years earlier in the global financial crisis when Lehman's went bust. If we're at a level we're going to get that we had last 6 years, happy days. We'll all be popping champagne and partying in 5 years' time if we can repeat what we've done over the last 5 years. But I generally don't think that's going to happen. But is the equity market outrageously expensive? Absolutely not. It's nowhere near as expensive it was as in late 99. And everybody gets obsessed with what happened most recently. We call it snake bite. Walk through the grass getting bitten by a snake. I guarantee the next few times you walk through the grass, you'll be looking for that snake again. Snake bite. So you're always worried about the thing that got you last time. But with investment management, you've got to worry about the things that haven't got anybody for a while. So we've not had a bond crisis. We've not had a massive increase in interest rates for over 25 years. What if that's the next crisis around the corner? What if bondholders are going to get wiped out rather than equity holders? You know, and I think that's more likely, and that's a risk we've been avoiding. We still think that in the long run, we can deliver reasonable returns from what's available in the market. We're not out of risk assets, be quite clear. We like risk assets for the long run. But what we're trying to deal with is the possibility that you're going to get some big wobbles in the next year. At the moment, it really is plotting a midway path, and I think that so far, bearing in mind the last year has had lots of interesting incidents, mainly coming from politics, Brexit vote, Trump elected, etc., then I think we're doing okay with that. But we've got to be so mindful of the possibilities. And we call that managing the tail of the risk, you know, standard normal distribution. You're trying to manage the extremes so that you don't get caught out if there is a major shift in the market.